Hello and welcome back to another special episode of Fun Friday with an incredible guest once again. This is someone who Rob and myself have looked up to. We appreciate all that he does, and he's got his feet all over the place. Irons in many fires. He's really well versed in many aspects of real estate and also, of course, has a very unique story. Please welcome Matt Owen, founder of OCG Properties. How are you today?
What's up, Craig? Thanks for having me, man. I appreciate it. Looking forward to
Absolutely.
this.
Yeah, well, it was nice seeing you last week, obviously at Raise Fest. This will be released not this Friday, but or from the Friday after, but nonetheless, always a pleasure seeing you at the Raise Fest, Raise Masters ecosystem, and looking forward to having the conversation with you today. But let's just, yeah, dive right into it. What did you do before getting into real estate? Because I know I've heard your story before. It's pretty unique and interesting compared to the typical person that gets in the real estate world. So why don't you share a bit of your background?
Yeah, for sure, man. Absolutely. And I kind of fell into it to be honest with you and found real estate. And that's where my interest was immediately piqued. So I grew up in Southern California, went to UC Santa Barbara, got a degree in economics with an emphasis in accounting. Really was only going and getting going into accounting because I didn't want to leave the school there because it's Santa Barbara and it was, parties all the time. And, I was still stupid, I'll say at the time. And I'm still stupid according to my wife sometimes, but it is what it is. So,
Yeah, not a lot of
so
people
I,
want to get pulled out of Isla Vista, is my
yeah,
understanding.
you're
Yeah,
just like, can I stay here for 6 years, please? Like, that'd be great. So,
yeah.
but anyway, so I graduated from UC Santa Barbara. I went and got a job at a CPA firm, got my CPA license right out of college, and I was working at a CPA firm doing audit and tax work, and working on a lot of real estate clients doing audit work for those multifamily buildings that were government subsidized and things like that, and got to see kind of the inner workings and all these crazy structures they put together to do asset protection and mitigate taxes and things like that. So from that side, it was really interesting. But if anybody's ever done tax or audit or understands that, it's probably one of the most boring things on the planet, of course. And so I jumped ship to another firm where I got to see a lot of the inner workings of small businesses, both manufacturing, distribution, and all different real estate and other businesses as well, more on an internal controls level and an operational level to be able to see how that side of the business worked and tried to help them with proper segregation of duties because employee theft is one of the biggest thefts out there. And so being able to see that from that angle gave me a lot of insight as to how businesses run as well as how real estate works. And I remember sitting there doing another dang tax season, working 70, 80 hours a week that month, and just getting killed and being in a lot of pain, going, I can't do this anymore. How do I get out of this? And I had I'm like, should I open a bar? What should I do? Like, I don't know, something else.
Anything,
So not
right?
anything else, right? And my stepbrother came to me and he said, hey, you got to go to this class with me. It's really amazing. It's all about real estate, and you're going to be able to see, they have all these ways of teaching you how to do this to start something else. And, I first thought, hey, you're getting jacked, right? How much money did you spend on this real estate education, bro? And I was totally going to flake on him. I ended up going, and long story short, I quit my CPA firm to jump into real estate after getting my very first deal under contract where I was going to flip it and make about 30 grand on that flip. And ended up making 20, but because my math was wrong and I did everything wrong. But quit my firm job, went right into real estate. And honestly, we started flipping houses right away. Both my stepbrothers, who were computer programmers and electrical engineers, and myself being the CPA, we're supposed to be able to talk to people in real estate. That's like not our personalities at the time, right? So, so that's how we started off, and it was 2006. So I was a real estate genius for about a year and a half before I got my ass handed to me and lost everything when the market crashed and punched in the face really hard, of course. So, so from that aspect of things, that's how I started off in this journey. And of course, by a giant punch in the face, it's probably honestly one of the best things that ever happened to me at the end of the day because you learn how to stand back up in this game. And of course, if you don't know that skill set, you're going to either learn it or you're going to go back and get a job in this game. So that's what's going to happen. And so be ready for those trials and tribulations because they will come, man.
Absolutely. And it's interesting because I believe the GFC was really predicated on the mortgage crisis, right? Which
Right,
obviously, unfortunately, one way or another, that was your direct access of exposure.
right.
Interestingly enough, now that you're, probably taking some different pivots and directions with inside of your own investing and capital raising and your journey there, you're obviously now in multifamily. But it seems as if the potential looming recession right now, one of the biggest issues we have coming up is obviously maturity and a lot of debt coming due and interest rates being really high as opposed to where cap rates are at the moment, which is obviously when equity evaporation is happening. So do you see some similarities between, that kind of 2008, 2009 progression to where we are currently right now?
So I think there's some similarities and a lot of differences. And in 2008, you had a major liquidity crisis, which could occur here again, especially with banks, being a little volatile right now, taking some hits, and some bank failures that we're seeing and things like that. That could be a major issue, right? You have a massive amount of multifamilies and commercial retail deals, office spaces, all the commercial debt market that services those asset classes could have some volatility because there's a lot of loans coming due in the next few years, and a lot of people are afraid of that space right now because of the changes in rates that are occurred. They're nervous about volatility in those rates and things like that that could occur that could leave the bank holding the bag or in a bad position with their own investments. And so, that is a concern. I don't know that it's going to go that direction. I think we've had a major hit already, and what we're seeing on the market is a lot of people coming in and saying, hey, we'll do capital infusions in these ways to do this. We see people mitigating the risk now, the smart operators saying, hey, I'm not going to do distributions. I'm going to hold back in case rates jump more. I'm going to hold back and make sure that I can refinance in 3 years per my business plan and make sure I preserve the asset in itself. The bad operators definitely had that, are having that issue, having, capital calls, running into issues where they can't refinance, they're not cash flowing. Expenses went up already as well as, going through and interest rates going up, not just interest rates. You're talking property taxes and insurance and inflation on those expenses. Now, rents,
Payroll,
yeah, all of
labor.
that has gone through
Yeah.
the roof, right? Yeah. So these are the things that I see, but I think the market has adjusted in a way where, you now as an operator, a smart operator, you're obviously going to go in and say, well, here's what the numbers work for now, plus additional potential downside risk protection in your numbers and your amount you're willing to pay for a property. And so by buffering those things in, you're already at a big discount compared to the ridiculous highs where people were buying at crazy inverted interest rates that, are going to smack them in the face long term, right? So that's, I think, the key is you're going to have good operators, you're going to have bad operators. I don't think the distress is going to be crazy because I think we're still going to see upward pressure on wages, maybe not to a crazy degree, but it depends on what happens with the economy as a whole. But with inflation, we're seeing inflation on wages as right now as well. So we'll see.
Yeah, no, and you raised a lot of good points there. I'm sure we'll unpack them through the show. But without a doubt, there is distress there. It's slightly mitigated. I do think we may be at the high point for cap rates right now. That's not to say prices won't go down, obviously, and just less income associated with the property. We could get a little bit of rent regression, but by and large, one way or another, the economy is humming, and the powers that be seemingly have set up a softer landing than what could have been if we just fully ripped the band-aid. So obviously only time will tell. But taking a step back, can you walk us first your first real estate investment and what that was like for you?
Yeah, I think my very first deal, I bought a property in Cheney, Washington, a brand new construction, single family home that was set up with a property manager in place, and everything was amazing. And I was losing $500 a month, and I thought it was a great deal because I was gonna go through and be able to hold a house for only $500 a month negative, right? And that was my mindset at the time. And after that, I went and got that first flip, and I took that major bath. And since then, we've now flipped over 1,000 houses. We have over 35 million now lent out to flippers in different markets around the country. I've raised over $150 million for real estate transactions that I'm doing, as well as outside operators that I work with consistently. And I really just help a lot of real estate investors now and passive investors create that cash flow stream through different instruments. I love multifamily. I love self-storage. I love mobile home parks. Those are great for getting big chunks of, tax deductions, building long-term wealth. Of course, in the beginning few years, as you're doing the value add, your cash flow's a little less, but it can really be juiced up down the line. I put that together with another pool of promissory notes because then I have a consistent cash flow that I can count on that side. But it's just giving me a different benefit. Yeah, you want that consistent immediate cash flow while you're building your wealth over here, which is definitely the most important aspect, is building your wealth, because promissory notes, yeah, it might fit a need. You're going to be able to go through and cover your net need on a cash flow basis there, but it's not going to go through and take you to that next level like a multifamily asset would, or a mobile home park. Some of those strategies, you're forcing appreciation and you're forcing your wealth build by utilizing operators that already know what they're doing, which is amazing. So I invest both actively in syndications now, as well as promissory notes, but also passively into other people's syndications, because there's only so much you can do as an active operator yourself. And I think people should do both, because you can mitigate risk and know how to do due diligence on deals and things like that as well, right? So my first deals were all primarily single family flips, doing different strategies, doing seller finance strategies, which is what got me into promissory note investing, because I would seller finance properties to people's IRAs and 401ks. I would sell a lot of properties to international investors in Japan and China because they could write off the house over 5 years for Japanese tax law for depreciation. So massive tax benefits there, and helping people with their 1031 exchange replacement property and things like that. So all those things were things that I did in the beginning to sell a house in 2008, when it was in 2012, when it was like the hardest time in the world to sell a house. And so it taught me all these different strategies out there on how to create promissory notes. And once you start understanding interest rate arbitrage on promissory notes, things get really, really interesting from a profitability perspective. That's the things that in a CPA gets excited about, right? So
Right. Basically finding some spread. And, you mentioned a lot of really cool things right there. The arbitrage play with regards to promissory notes or coupons, one way or another, whether it be certain positions within the debt structure. But what it sounds like is really, really cool. Then I don't think any other guest has actually spoke on this item, but basically the front term, short term solution, which is basically little notes, as you alluded to, not little per se in the dollar size, but notes there that might make you somewhere, a fixed rate of return somewhere between, call it 5 to 15% potentially on the structure of it, whether it be hard money or something that's a little less
Mhm.
aggressive.
Right.
And then obviously the long term play, which has a little bit of a nugget with the cash flow perspective, but you're doing a forced appreciation play like what we do at Lone Star Capital here, or you're buying a deal that maybe is underutilized in the marketplace and you basically do an equity infusion, right? But typically speaking, what type of deals and opportunities are you looking for today? Obviously you've got a really, really dense and robust experience with regards to the real estate world on both sides of it, not just the investor side, but on the debt side, which probably lets you uniquely look into deals and underwrite position. I know you famously have your 200-point due diligence list, but with that said, typical deals that you raise for right now, what are you looking for? Where do you think the opportunities lie today?
So the first thing I'm looking at is whenever I'm investing in anything, is the operator, and saying, do they have the experience to do this in the first place, right? Who are they? What's their background? What's their experience? What is their, and then I kind of look at what their underwriting is to say, what does this deal look like? And are they being conservative or not? How are they structuring, these different deals, right? So from my perspective, you're looking at how do you go through and mitigate the risk in this kind of a market, right? So when I'm dealing with any prospective new deal out there, I'm actually going through and first looking at um, what is my downside risk? What happens when there's changes in the market that occur? And what happens when the rents drop or expenses go up? Where's my break even point on that particular deal? So that's one of the first things I do when I'm investing in any particular deal, is understanding where's my downside risk protection here and who's the operator that I'm dealing with. Does that make sense?
Absolutely, it does. And that's so key to think about. We actually, in fact, on our presentation have, can you hear me? Can you hear me? Hello, hello.
Yeah, I was cutting off for a sec.
Yeah, no, I think my internet's stable. We'll cut that out, of course. But are we good now?
Yes, there we go. Your video's back.
Cool. Awesome.
Cool.
Cool. Sorry about that. Yeah, it does make sense. And funny enough, what we actually look for and what we put on our investment presentation, which a savvy person like yourself will appreciate this, what we do is we put our break-even occupancy on deals. So we have our going in occupancy, our stabilized occupancy, and our break-even occupancy, because I think so often in this business, people do really chase the highest IRR. And I do think that's a fool's errand as opposed to, hey, what's your downside looking like? I honestly, as an investor, as long as I can solve for a 10% return or better, I'm actually pretty darn happy with that. Now, you can see this or that number here and there, but a lot of the numbers are really predicated on what the exit cap rate is, right? So if you tinker with this, tinker with that, you can really see what the makeup of the deal looks like. So when you do get a deal, what are some of the other key metrics do you look for? And, how do you kind of handicap a deal as well? Because obviously, if you can raise money, money finds you and deals find you right away. Right.
Right.
So when you get pitched a deal, what are some of the things that you really cut up and need to hit? How do you kind of look at a downside protection? What do you handicap? When you see the model, do you basically strip it down and put it into one of your models? Because I know you like to underwrite, being the CPA, having a numbers acumen that you have. I know that you do like to pick things apart. So I'd be curious to know how you perceive things to feel safe in an opportunity.
I'll have to tell you, these 47-inch monitors behind me are amazing with Microsoft Excel and financial modeling. I love that crap. So you're
Yes.
speaking my language. And I
Yes.
really do, when I'm doing a financial model analysis, I'm looking at all the key assumptions and saying, do I agree with those assumptions? Is this operator being conservative, or are they being aggressive in their play? Do I agree with their downside risk protection? Do I agree with how they, feel they're being conservative or not conservative? And so that's one of the first things I do look at. Yes, you want to look at return. And you brought up a good point with investors looking at return on investment. And really what they should be looking at is return on investment based on a risk adjusted basis, right? So you could go into a multifamily deal that I've been in multiple times that is going to give me a 7 to 8% cash on cash return over the long run, and then a 15% IRR. And it's a slow, steady value add play, no major renovation, no major work involved, a very cookie cutter, long term debt, no refinance type situation where you're lowering your risk massively. And if you're working with a good operator, you're going, great, this one's going to perform long term. What's my break even? And I'm still okay with a deal in that range. Now, there's a deal that I just took down recently with another partner of mine where we bought a 172 unit mobile home park, added 52 or adding new 52 new units to empty slabs, rehabbing 26 of these units, and we're ending up at a 13.8 cap based on our projections at after we're finished at our cost. And so that is a major high return. We're looking at refinancing and getting all of our funds back and a 20% plus, IRR with all of our money back out of this thing by the end of year 3 or 4. And, but there's some hair on that one, right? There's some risk because you have to make sure that operator can perform in bringing those 50 units in, rehabbing those 26 units, having the good asset management team, the operational team on the ground with the construction side and property management, especially when you're dealing with dilapidated mobile home parks that don't have a great tenant base. That's a major cleanup job. I better be getting paid for that, right? On a return on investment. It's the same thing when I'm investing in promissory notes. In one of the funds that I work in, we pay people typically 8% on the funds, and but there's no leverage involved. We don't borrow against our notes from banks and insurance companies that will give us liens against these notes at 65 or 75% loan to value. But there's other companies out there where you can get 12 to 15% plus, but they're leveraging their notes at maybe 90% of the note value. And so if you do the interest rate arbitrage for the operator in that case, it's incredible. They're making 30, 40% plus on the money, and then they're paying investors that 15% or that 12%, but investors are now in second position on that note, and so not in first position, so the risk is through the roof. There are some other mitigating factors some of these different funds can do, like putting up extra reserves and things like that to mitigate that risk, but you can see clearly the difference between a risk-adjusted return in this example in either promissory notes or the mobile home park fund versus like a cookie cutter multifamily that just needs some good quality management and asset management work and maybe some cleanup, right? So
Absolutely. And obviously everything's so interest rate dependent. We're buying a deal right now for about 34 million and a quarter, where in 2018, the seller paid 33 million for it and they put $6 million of capex into it. They over improved the property. Now they're taking a $6 million loss, and that's our benefit there. But to your point, you really need to and ought to handicap properties and asset classes correctly. And I think you really hit the hammer on the nail there when you think about the key word, which is risk adjusted, right? A 15 IRR for multifamily real estate, a 15% turn in a hard money fund, or a 15% home in a mobile home park community are wildly different metrics, right? So
right.
can you kind of touch about how you get all these opportunities on your plate, how you handicap certain ones? Because you just think real estate, oh, real estate's real estate, but no, that's not true. This is, not really an apples to apples comparison, right? And even when you go market to market, it's not apples to apples. A return profile in Wichita, Kansas, as opposed to, I don't know, maybe one of the hottest places in the country, like
Like,
a
yeah,
Dallas, Texas,
right,
right?
right.
Those are different return profiles. That's a wildly different ballgame. So how do you feel comfortable with seeing so many different asset classes, but then really just getting behind the operator and the business plan, considering that numbers are not all made the same and plans aren't all the same?
And the numbers are wrong a lot of the times too.
They
So,
always are. Put
yeah, they're
PSA.
always
They're
there's
always wrong. It's just what
the,
direction are they wrong?
right.
And what image are they trying to paint?
Right,
Unfortunately.
right.
And it's
And
not that you're
that's the
trying to be
key.
wrong. Yeah.
Yeah, you're going to be, no matter what, it's not possible to not be wrong on a financial projection moving forward, right? You can estimate as best you can and you can try to be as conservative as possible. And so there's different segments of what I go through when I'm doing this. First, I get so many deals thrown at me now because I've raised a ton of capital that I literally get rid of 90%, or sometimes I just don't have bandwidth at the moment. I just can't do that deal because I got to make sure I take my time. I got to make sure that due diligence is done. And I go through my 200-point due diligence checklist, as you alluded to go through that process with different operators. And that due diligence checklist, it happens after my initial sniff test, right? First, who's the operator? Do I trust them yet in the first place, or do I want to take the time to get to know them to trust them? That's the first piece when I get a new deal in my inbox or something, right? Um, Second is it an asset class I like? Do I feel there's risk in that asset class right now? What's my general perception of that particular asset class in itself? Where's the market that it's in, and things like that, right? And then is the return commensurate? Does the structure look like there's performance-based incentives involved in that structure, right? Investors should get a preferred return. There should be a split, maybe up to another waterfall take, and then there's incentive for the operator to make more for you because they make more on the back end. So is it front loaded with fees where there are some fees? You have to put fees in to keep the lights on, pay for the marketing costs, pay for the due diligence and all that stuff. That costs money and a ton of time, right? Sometimes these closings take 3 months to get closed. You're talking about a lot of time to get that stuff handled. And, big chunk of these don't ever close, right? So you're just, thinking about the single family business, right? You're spending a ton of money on pay by click, direct mail, going crazy doing that, spending $150,000 a year to get, 3, 5, 10 deals a month. But a bunch of those don't close. You're probably working on 20, 30 of them. So there's a machine in the back office there, going through and finding all these deals and doing due diligence on these deals. And so you still have to have that fee structure up front, but is it too much, right? Are they charging you 5 points on the front end versus a couple, right? And what is the compensation for that operator involved? Are they getting paid a killing in asset management fees, or is it reasonable for the workload that's being done involved, and then they're making the majority of their money with the profits that they're creating out of the deal? So I look at those things as my initial sniff test, and then I start getting into my due diligence checklist on this stuff. And in that due diligence checklist, I'm doing a deep dive in some major categories, right? The first part is the operator in themselves, the legal documents in themselves to understand those, the financial model on that deal, because that's crazy important. The and then of course you're looking at the entire due diligence package that they provided. Do you agree with the projections in themselves and all that kind of stuff as well? And then what is the market that these properties are in? Is this a strong market? Is there a population increase? Is it a communist market that's going to take away your rent rights and things like that? I just heard in Santa Monica, California, they just implemented a program where you have to actually, if you want to evict a tenant because you want to raise rents and rehab it or something, for like a studio, you got to pay $18,000 to evict. For a one bedroom, it's like 25, and then it goes up to 35. And I may be wrong on the exact numbers, but I saw the article and I was like, this is insane. They're just stealing properties from property owners in this case because they're just going to dump them. And so you got to make sure you're in the right market where the tenant landlord laws are in your favor and they still believe in contract law where governments don't step into contract law. These things are extremely important when I'm looking at long-term vision of where, am I going to hold something for 10 years, 15 years? What's going to happen in this property? Even if it's 7 or 5 years, what's going to happen in this market in 5 years from now? And so those are the main categories that I do a deep dive on when I'm starting off this due diligence process.
I love that. And you hit something there that's so key. And it's not that we want unfavorable, only, laws that help, us, property owners. We understand that there's two-way street and we have to hold up our end of the bargain. We have to provide a safe and clean and hospitable place for our tenants to be there, and the market will react accordingly. If you don't provide that, you're not going to get tenancy, you're not going to be rented, your occupancy is going to dip low. But it's so important. One of our missions at Lone Star Capital, of course, is we don't invest in beautiful cities like this because guess what? To your point, the laws change. I'm from Northern California. I know you live, I believe, in Southern California, kind of outside of LA or kind of in greater LA County, right?
Yeah.
And,
Orange County. Yeah.
essentially what's going exactly, which is, more conservative than not throughout, probably more libertarian, which I know you are, of course, a libertarian and a proud one. I think most reasonable people are, in fact, libertarians. I digress. But the moral of the story here is what you said is so important. That's just being in an environment where both parties have, their end of the bargain to upheld. And that's why we love Texas. And it's giving us great tailwinds because, a lot of our investors are people that live in states we want to invest in, like California, New York, and whatnot. And, Washington's, of course. And unfortunately, the laws have changed, but not really to a balanced perspective, but to an unequal balance of power into the tenant end where you have to pay people to leave. And that's just something we don't want to deal with. And that's going to be a headache for people and future values on top of the
Right.
incredibly high property taxes and insurances that some of these states have as well. But with that said, on the 200-point due diligence checklist, how many times have you sent it over to people or have they heard that and sponsors just like, okay, well, I'm not interested because they just don't want to go through the process of it? Because I have to imagine that questionnaire, once you get it done once, maybe you have an updated question here and there that's added, but you've probably done the work. And if you're willing to go through that gatekeeping process, I imagine your relationships for the most part solidified at just a per deal basis, not a, recurring, ongoing questionnaire. Is that right?
Right. And so normally what I do is, if I'm starting out with an operator to start, I'm reading all the documentation, I'm reading the doc, all the PPM and the operating agreements and the deck and all that kind of stuff, and watching the webinar, trying to learn more about the history of that operator, and I'm documenting it on my checklist as I go through that. And then I'm coming up with a massive list of questions to go over with that operator and do an interview with them, or I'm going through and sending it to them and saying, hey, look, I know this is a lot. Here's my missing questions. I'd love to know if I'm right or wrong on some of my answers here of what I found in your documents. I don't care if you do a recording of a video and just answer those questions on that side if it's easier for you, or send it to your staff in segments based on, so you want to know more about the market analysis and what background you've done on that, then great. Now, there's also other things like I do a background check and a criminal check every time when I'm working with a new operator, right? That stuff is mostly done up front. If I've been working with them for a few years now, I might do another one just to make sure I'm not dealing with some crazy people, you know? So, but at the end of the day, I'll do those things and I'll try to deep dive with the operator and do this discussion with them and talk with them about these and document everything that I'm doing along the way so that I have this for future reference. Because as you know, if you're in a conversation with somebody, you forget like 90% of what they said, or you might have a few notes and then you might throw that paper away later because you're like, I don't need this anymore. I get it already. And then you're like, wait a minute, I want to go back to that, on their next deal and I forgot all this. Or you want to talk to some of your private investors. You're going, this is a crazy, amazing deal. And then they're like, well, what homework have you done? And you want to, okay, well, great. Let me go back and go redo this 200-point due diligence checklist again. And so that I can show them this is what I found with them, no representations, but this is what I'm seeing with regard to this operator and the answers to all of my questions. So, and that helps a ton when you're bringing, when you're working with other operators and you want to help raise capital for those operators as well. I raise capital for very few operators because it takes a lot for me to get involved and do a homework on those operators. Of course, at the same time, it's a godsend when you want to come back and utilize that later on. Say, this is what I found, and this is what I'm seeing now on my deals with them. So you can always update the documentation as well down the line. So, but yeah, and we have it on our website. We can give it to you for free, MathewOwens.com with one T in Matthew, because my parents couldn't spell correctly. So I'm just saying that, but that's my thing of why I only have one T in my name. But yeah, MathewOwens.com. There's a link in there. You can just download it for free anytime you guys want.
Absolutely. And we'll obviously put that in the show notes. And obviously, a shameless plug, as I'm the king of shameless plugs. At the end of the show, we'll figure out where we can find you. And I love that. And, as an operator who has nothing to hide, and as someone who wants to go through the diligence point and earn your business and have it be a programmatic long term relationship, good operators aren't going to be scared by that. But those who maybe are lazier or arrogant are going to be turned off by that, which is
Right.
perfect because you want a gatekeeping process.
Right.
This is a mutually beneficial street, right? And the thing on your end that I really respect about you is that, if you're going to put your name and neck out there, you better get your questions answered, or why am I going to put my reputation at risk by investing with you, right? So do you have any stories or examples, for instance, where you went through the process, maybe you were excited to work with someone and then you found something that you were not happy about, or any situations where you're close to them and then you walked away, or people kind of turning or scoffing at the idea of doing the 200-point questionnaire and question list?
Yeah, so I, during that interview process, when I go through that with them, I'm sitting there gauging their reactions to my questions. I'm getting to know them and looking at how they react, right? I'm trying to understand them from a psychological standpoint. Are they annoyed with these questions? Because if that's the case, I'm out, because just like you're talking about, a good operator is going to say, look, I know this is part of the process. If I want to earn this guy's business, then great. I don't care if they think that I'm only going to put in $25,000 into their deal and I'm not a big investor at all. And I actually play that game sometimes and tell them that, yeah, I do a lot of stuff, but I know I only put in 25 grand into a deal, which is, not true. But I'll say that a lot of times because I want them thinking I'm a small investor, because I want to see how they treat small investors. I want to see how they react that way and understand them from a psychological standpoint and ask those tough questions about, have they thought about their break even? What point, if rents drop by 20% and expenses go up by 10 or 15%, are you break even? Are you losing our money? Where are we at? What about the refinance? If they don't have answers to those things where they've thought about some of the key risks up front, that's when I'm like, wait a minute, hold on, they didn't think about this risk. And sometimes it's hard because they just don't think about all the risks. But
Or at
if
least
you're an
at least
operator long enough,
yeah,
yeah,
at least have a model of it, right? At least be able to show me, hey, you know what, good question, you know what, likely this deal wouldn't pencil, but at least probably have an answer. And you
yeah,
probably rather respect that than someone being flippant or disrespectful or like scoffing at it, right? So at least
yeah.
have some sort of example in your modeling that could probably lend evidence that the deal would be okay if that happened. Is that correct? Is that really
Right.
really what
Yeah.
really
And
what you want to see?
exactly.
Yeah.
And most of the time they're not, they're not scoffing at it most of the time. Most of the time I see them lose interest and, and then they're, you could tell they want to get off the phone, right? If
Hmm.
that happens, then I'm out, right? And this has happened, so many times where, like you said, I stop in my tracks. I'm like, I'm just not comfortable because, I've had enough people steal from me and screw me over that I was like, no, this guy is gold. This girl is gold. There's no way they're stealing. Like, and just, I swear, me and my brother have a joke that goes around every time someone like screws us. We're like, did they seem like they knew what they were talking about, dude? Because like that's the thing that seem to find a way to screw us, right? So we are very aware of our own emotions now when we're investing because we're like, wait, just because I like you, doesn't mean that I'm right now because the really really good con artists are the ones that are talk the best game, right? We
Yeah.
got stolen from by $450,000 from a contractor last a year and a half ago, where they did fake permits, they drywalled things, pretending like all plumbing and electrical was done, but had fake permits. They had fake invoices. They and the first two deals they did them perfectly. Not a single punch list on the bids or on the jobs that we gave them, and like super rare for a contractor. And I got all excited, and I liked the guy, and he was like really
He's the
really
one.
out. Yeah, he was outgoing, right? And we gave him like 8 projects and took the first draws, defraud paperwork like crazy, defrauded pictures, like all this stuff that was absolutely insane. Like he put instead of the 12-inch wall tiles, he put drywall or he put wallpaper up that looked like the 12-inch wall tiles. Like that, you're taking work to defraud people here. That's like insane. And so, but
Well,
he got me. He got me. It was sucked.
well,
So
that's really interesting too, because thinking about that, he probably is good enough to actually have jobs. And if he just
yeah,
did the work and to take shortcuts, you wouldn't have to do that, which is this is the funniest
right,
part. If you build a good business,
right,
being intentional and are okay with slow growth, which is the only growth that I want to be a part of, frankly, because
right,
anything that comes quickly means there's no moat around the business, right?
right.
So if there's no moat around your business, and if you want to go too quickly, the quicker you burn, the faster it might go away. So we want to be in the long-term relationship growth where, we've seen each other now probably 7 or 8 times, different places, and we're
Mhm.
developing, as Brian Spear would say, the 7-11-4 principle, right? 7 different places, 11 hours, or sorry, 7 different interactions, 11 places. Well, I don't know, something like that. But it goes to the principle of, being around people enough and long enough, and having that there to develop that relationship and
Right.
getting people feeling comfortable. So it is unfortunate that people do operate out there like that.
Yeah.
But where
And
was
it was my fault. I mean, I was excited. I found he did 2 deals that were perfect. I gave him a bunch of other deals. I didn't do a background check, and I should have done a background check on this contractor. I normally do, but I was excited and really in need of a contractor at the time, and did it anyways, and moved forward with it. And then this is why you in part of the due diligence checklist when you're working with operators is you go out and you call all of their references. You go if someone gives you a list of 20 investors to go call every single one of them. Make sure they understand, the reporting that they've done, how there's their communication, how did they perform in the past, and that mitigates a lot of this risk. And I look back and I know exactly what I did that I could have mitigated that risk majorly from doing that piece, and it screwed me from one mistake. And you learn those lessons the hard way, and the more punches in the face. So it is
Yeah.
what it is.
So with that said, what was the evolution and the creation process of that 200-point due diligence checklist that you're so famous for?
Yeah, so it really came down to me wanting to be able to show some larger investors that I was working with why they could trust some of the operators that I was working with and backing that up in the first place. I was already working with these operators, and so I started putting it all on paper, all the stuff that I was doing every time I met an operator, and I started documenting all of it. And so this is what needs to be done on each segment of this, and just basically writing it all down in the first place because I wanted to show a very big capital source of mine. Hey, look, this is some of the diversified deals that I'm seeing out there in the multifamily syndication space, in the in the mobile home parks, self-storage notes, all these different strategies that I know how to invest in and implement, became really interesting from to a lot of my investors, because they're like, wow, you can build me a portfolio here with some of the strategies you implement. And so I was like, how do I document this and show them and say, this is why I invest with these operators, but let them also make their own decisions by just documenting my findings instead of giving a, investment advice to them. And most of the time, these high level investors, they don't need a lot of hand holding. They know what their risk tolerance levels are, and they're the ones doing their own homework on these deals anyways. I just give them insight as to what I found with regard to these operators in the first place.
Well, I really like that thought. And the biggest thing that I like to say is I don't even, obviously I'm in a sales role and I'm a sales guy, but truly I feel like Lone Star Capital and our product is so solid that, I'm not having anyone do something they don't feel comfortable with. And I'm basically relying information and kind of presenting the facts. And our deals are subscribed with or without a new investor coming in.
Right.
So we love to earn your business. We love to kind of have you come in right when you inbound into our system and processes. But
Yeah.
if it takes 10 years to convert you, by all means, sit in the sideline and, watch us, do the deals that we're doing and,
Right.
make the money and, come in and, the referral base and the testimonials will only add up. And whenever you feel comfortable to come into play and to make things happen, by all means, come into our systems. We're fine. I don't feel like I'm selling anything, as you said, and I think that's kind of what you alluded to. These are big boys, these are big girls that are making these choices. It's just leading them there and presenting the case and filling out what their pain points are and what the needs that you're serving are. And I remember hearing your story. I think it was regarding your child and basketball, and kind of the why you wanted to get out of what you're doing before was because you were in a situation where you were so bogged down from a time perspective that you couldn't really give back to the things that were most important for you, considering how successful you've become. So, do you want to just briefly maybe share that story and kind of, really what brought you more into the capital raising side, the passive investing world, and kind of creating these sources of income that are, more passive and hands off after the front loaded hard work and the due diligence chess points have been checked, crossed off?
Yeah, absolutely. Now, in the beginning, you're trying to build wealth, right? You're building this massive business up. You're trying to, build as much wealth as you can so that you can invest it into passive cash flow deals and be able to retire off of that. That's the goal, right?
Live
You
off
don't
the
want
interest.
to, right. And, you can try to go through and scale a single family flip business. I got a buddy of mine that flips 500 houses a year. It's insane what he does, but he's got, a 5,000 person management company, and has his in-house construction crews, and he's got his own warehouse, and to do this, you're talking about building a massive system and business, right, to scale the single family business. Or you can say, hey, I'm gonna do this all myself, and I'm gonna go and buy one house at a time, and I'm gonna flip it, or a couple houses at a time, and I'm gonna flip those things, and I'm not gonna have a lot of employees. There's just gonna be my own shop, right? Keep in mind, either one of those businesses, unless you built it to that full scale where you can outsource yourself, which is very difficult, you are trading your time for money, right? Those are active businesses. My lending business was an active business. I buy a lot of paper. I also originate, but I've been able to step out of that and keep it at bay without having to take up a ton of my time now on that side. And the reason why I did that is because I was in pain. A lot of you parents out there probably fully understand. I got the whole dad vibes hat thing going. And, it's like when you're a parent, your number one pain in life is not being able to spend time with your kids because you're working too hard, or you don't have enough money to feed your kids. Of course, that's always a difficult thing in this day and age, of course, too. The financial headache and stress of being able to build a income stream to be able to cover your financial needs and protect your kids at the same time as being able to spend as much time with your kids as possible. They're not really conducive of each other if you're trading your time for money like that. It doesn't
Yeah.
work long term. You're going to end up being 80 years old and, not and regretting that all you did was spend your time on making money instead of these kids that all they want is your personal attention. That's all they want. Could you imagine a kid that all they want is look at you and say, just give me time, dad. Give me time. And it's the most painful thing in the world if you can't give them that time because you got a million other things, which is what pushed me to have this shift, in addition to the fact that if I can't figure out how to create passive cash flow where I'm not working for it anymore, then how am I going to ever teach my kids how to do the same thing? And they're going to be in the same pain that I was in with trading my time for money nonstop and not being there for them. And so those two things of being able to show them how to do it and be able to spend more time with my kids is really what pushed me enough pain to push me out of active operations and to be more passive, focus on raising capital for other operators and things like that, that I can work with and rely on other team members' experience and other operators' experience while I add certain values to the table. You know, that might not all be raising capital. It could be financial modeling. It could be lending consulting. It could be a number of my other skill sets that I have, of course, to bring to the table, but it doesn't always have to be as active. It can be as active as I want it to be or as passive as I want it to be.
Yeah, no, I really love that. And it's super special. And I think, so many people unfortunately get to the point where they're making good money, but they do that at the sacrifice of their home life. They do it at the sacrifice of having no time with their kids, not knowing who their kids are. And, ultimately, if you're making a lot of money, yet you don't have freedom, what is the point of making money? Money is all about a tool to improve and ease your life. It is not to, play the game and be in the rat race. And what you're really talking about is leaving the race. It is getting to the point where you can say no to opportunities and scaling your life up or down to your needs and wants, depending upon where you are at, which is so special and unique about yourself is you've had both ends of the spectrum. And now you're choosing to do something that you're obviously really good at, you're skilled at, but also is lucrative too. But it's changing the paradigm away from, being in a 9 to 5 position to creating your own hours, being an entrepreneur, developing these, independent skill set that are all intertwining and connected together. So if someone, was in a situation where they had less time and they needed kind of a roadmap to get out of it, I've never actually asked anyone on the show this, but what would you give them as the blueprint? Because you really are the blueprint to that. You had the corporate jobs, then you went to the flipping route, then you're in these passive positions. So what would you give someone a blueprint for if they were really looking to leave that kind of lifestyle?
So I think the biggest thing that I would do is start focusing on finding operators that you can work with, right? You're either going to go and build it internally, build a team internally to do this all yourself, or you're going to find other team members that you can work with. You want to start going out and doing homework on operators and finding what skill sets they have and what ways you can help them. Right. So, and the way, a lot of ways is by raising capital. That's one particular way. There's a million other ways. And unless you're a licensed broker dealer or you're structured correctly, you got to be real careful about capital raising laws involved, right? And so you want to make sure you're structured right or licensed correctly to be able to do that skill set and bring that skill set to the table, along with a bunch of other activities that you can do to be able to increase your ability to add value and make money with these operators. So, raising capital is one piece of it, but there's a million other ways to add value with these operators that don't necessarily bring, as far as bringing money to the table. If you're an active operator and you want out, start taking your profits off the table and putting it immediately into cash flow assets and wealth building assets. And you got to put that aside every single time you get a cash infusion on deals, or your business is going to burn the money. It's going to go through it if you put it right back in the business. So I would absolutely focus on that.
Yeah, and you just raised a lot of good points and mindset thoughts and shifts there that are super crucial through the evolution of everything. And when did you realize you didn't want to be an operator anymore? Was it basically when you wanted to give more time back to your kids? Because I think so many people go through that inflection point of, do I want to be an operator? Do I want to be passive? Do I want to be somewhere in the middle where I bring equity to deals? And if you're looking for ways to bring equity to deals, I encourage you to watch our SPV fund of fund webinar and documentation, as well as the information I put together with Travis and Brandon and Dasha with TribeVest. But that's a side plug to older shows that I've done. But what would when was your inflection point in realizing, hey, I want to be more of the kind of hybrid position slash passive position?
Yeah, it really came down to I've built my businesses based on diversifying my investment base and offering multiple structures and strategies for investors to invest dependent on their interest, right? promissory notes, direct single family homes, short-term rentals, multifamilies, the mobile home parks, all different types of investment types. And so being able to add these has been really the key to this entire structure, and being able to add the new deal flow to the pipeline, along with the scalability of it, to be able to be a lot more passive. And it really came down, like I was saying, to the pain of not spending as much time with the kids, the pain of just nonstop workload all the time, and pushing me in that direction, and realizing that that's the most scalable way to build your own portfolio. Both actively, you're being active, but you're putting all of your efforts into getting passive investments, right? If I was to do it all over again with my single family homes, I wouldn't have sold anything. I would have just held all of it from the start. And it was just a mindset shift, thinking, oh, I got to flip because I need to make money for this so I can keep the lights on. No, you only need to flip a little bit so you can keep your lights on personally. Everything else should be holding for cash flow long term and building wealth for you immediately instead.
I love that. Transitioning right now out of that kind of part of the conversation. Um, Obviously, there is some looming issues going on with the economy. We've got debt maturity coming up. But what is making you, I guess, most nervous with the recession coming up? Is there anything that kind of gets you a little bit uncomfortable, maybe with your personal positioning or just as a macro American level of the economy perspective? What is kind of maybe keeping you up at night or you making you a little bit nervous?
Just like the World Economic Forum says, I'm worried we're going to own nothing and be happy because that
Yeah,
the
and eat
government's
the
going to take it
crickets.
all. So
Yeah,
yes, and
yeah. It
so
looks
I
like we're watching similar things, isn't it?
yes, it is.
Yeah.
I know.
And we
So
probably believe and do similar things as too, as we've talked about.
trust me, during the whole pandemic thing, I'm looking for a place in Texas where I can have a farm somewhere on a lake and have my own food and food
Yeah,
supplies.
and
And
some hopefully some creek and spring water coming through for
yeah,
obvious reasons. Yeah.
that's all I needed, right?
Yeah.
So some solar power and composting toilets, and there you go. So, looking at it from, that's honestly, that is a bigger risk, the control of governments and how they're coming down to take away our rights. And I personally think it's important to diversify into different countries and different asset classes for that purpose, and even hold hard assets like some gold and silver for an insurance policies, and some commodities and things like that separately, as a diversification approach to investing, right? And so I look at those risks in that manner. I think there's always going to be a risk of a banking crisis. If we keep seeing the inflation rate going up, right? Nobody believes that it's the 4 or 5%, 7% inflation that they're touting. We all know, based on shadowstats.com, that this is in the 15% range plus. And when they take out food, and they take out housing, and they take out transportation and gas out of the equation, and start putting less weight to those things, then they're just lying. Everybody knows food went up like 30% in the last year.
Can you
I'm
can
cons
you re-reference that website, please? Because that's a
um
really interesting.
Yes, shadowstats.com. Absolutely
Yeah.
a
Yeah.
great, site to go take a look at for sure. And, when you start looking at some of these risks, the bigger risk is that food prices and general living expenses outside of housing, outside of, what you look at as someone's credit, car loans, house loans, and that's being considered for this, that affordability is even squeezed even further, because if someone can't eat, they're not paying their rent, and so if that's going to be the first thing that they're like, well, I won't have housing, or maybe they'll try to evict me or something. And so I look at that risk as a more serious risk. If wages don't keep up with the inflation on food prices, then that's a scary factor, right? And so, and what's happening with credit card debts, what's happening with auto loans, what's happening in those fields, I'm looking at to look at a general affordability much more closely.
You raise a really good point right there. The number reason why people who have houses right now that are doing cash out refinances and are reshuffling their profile is not because they're pulling their money out to buy another house or to do this or do that. What they're doing is restructuring their debt to have a 6% interest rate on their house as opposed to that, sub 4% rate before. To do what? To pay off their auto loans that they're delinquent on, to pay off their credit card loans, because those numbers are a lot more punitive at 26% or 30%, and are going to hit your credit a lot harder than maybe having your mortgage payment now now be a couple $100 higher or whatever it may be. So you're
Right.
basically extending and pushing that away to reshuffle your personal debt and deck right now, so that's something to think about for sure. But
Yeah.
this is
And
also, yeah.
right. And we have a really big broken housing market right now. Everybody says that, hey, there's, no supply on the market. And yes, you're right. No supply because you locked in a bunch of people, like 80% of the population at sub 5% interest rates, that they're going, hey, if I trade up to the same house, I'm going to double my mortgage payment if I have a 3% interest rate or more. That's crazy, right? And so, that locked people in, artificially destroyed supply. And then we also had the rate increase, which destroyed demand also because affordability got destroyed. So I wouldn't say we're necessarily, in a housing bubble necessarily. Yeah, maybe from a price standpoint, but they just printed all this money like crazy. And so, inflation's going to continue to occur in housing long term, no matter what. Depends on what happens with short term volatility with regard to banking and stuff like that. But, you have a locked in supply and a massively reduced demand because people can't afford that house anymore, because rates are so high. So you have a very even keel of supply and demand right now, that you're seeing in the housing market. And unfortunately, a lot of it, private investors think housing, they think economy. And so, in it might affect other asset classes and in people's fear, because they may think, oh, real estate, housing is the same thing as multifamily, is the same thing as self-storage. They're totally different animals and actually move differently many times along the way. Yes, the interest rates hurt a lot of these asset classes now on the higher commercial scale, but they're very much valued based on how much cash flow they produce, and there's still strong demand on rents because nobody can afford a house right
Well,
now.
also,
So
why do you think we play in the affordable housing sector? And what's more creative than buying Noah, as you know, with your past investments with Post, who's great, naturally
right,
occurring affordable housing coupled with a tax abatement structure? Well,
right,
that's about as unique and as creative as a strategy
absolutely,
that could play right now in the marketplace. There is not a better structure you could probably invest in if you're getting a deal where you can basically buy it at a market rate number and then slap a property tax abatement on that. That's
right.
how you generate alpha. That's how you also generate the best risk adjusted returns. And that's what we're looking for. And you just hit so many great points. We could
Yeah,
talk
I
forever.
love that
But
structure
yeah.
because there's a lot less risk with those types of deals that you're doing with the tax abatement structure. Because yes, you can increase rents, value that get a value play there, still have some units affordable, for downside risk protection, because A buildings are going to move down to B if there's an economic collapse. B is going to move down to C. C is going to move down to mobile home parks, and things
Even
like that,
even if
right?
there's not
So,
even in an economic collapse, but you look at Austin, Texas right now, which has 50,000 units coming to play. That 2012 asset that was built pretty well located is at a B plus now because there's, a
right,
couple thousand units in the area. You got to discount your rents,
right,
maybe. So this is the strategy and emphasis we want to put on is being really smart on the location that we're buying it, but also knowing the replacement costs and knowing
right.
where, most people are living. Most people are not living or having setups with the beautiful monitors in the background or me here in my nice home office and whatnot. That's not really how most people live. So just thinking about it from that perspective is super
Right.
crucial.
And you're
Final.
getting a significant increase in value just by abating property taxes, which massively mitigates risk for investors because you're automatically getting equity protection from doing that. That is like the fastest value add play you can possibly do, is that structure.
We just did a CHODO. You'll appreciate this. Are you familiar with the CHODO structure?
No, I'm not.
Yeah, so it's community housing development organizations through a nonprofit, and
Okay.
effectively we put in a partial tax abatement. There's some stipulations to hit that. We'll talk offline about it. But essentially, day one we eliminate 50% of the property taxes. Going in rents are 941, stabilized rents are 940, and we're projecting about an 18 IRR. Do the math on that. Pretty sweet.
That's
So
awesome.
yeah.
Yeah.
So yeah. With that said, what is making you most excited about the opportunities coming up? Because obviously there's pessimism, but we all know playing the cyclical nature and the market game, this is the time to invest when the real deal and all these other headlines and articles have, negative sentiment. And when investors are a little bit snake bit is the best time to deploy equity. So with that
Yep.
said, where do the opportunities lie? Where are you putting your money right now?
So I really think, in an economic situation where people are fearful, you are going to see much better deals. You're going to see people taking discounts on properties because of fear. And usually during 2006 through 2007 and 8 through 2012 is when I was getting my best deals. I was getting crazy discounts on properties. And because of that, volatility that we saw. Now, I don't think this one necessarily is going to be anywhere near like that. And I don't think we're going to see a crash in, a lot of these asset classes. And I'm focused on asset classes that I think are going to have long-term value. Every single market is completely different, right? Texas is a totally different market than California. That is a totally different market than Colorado or any other markets that you're seeing out there, right? So you have to look at what you think is going to happen in that market long term when you're assessing your risk of these types of deals, so that's one of the biggest keys that I'm looking at is how do I make sure I'm investing in the right markets with the right operator and the right risk profile. Even if there's some volatility down the line, am I still going to be okay? That's the very first thing that I'm looking at is preservation of principal first. And then am I making a good return? Am I making a good bet on this operator? Am I going through and finding the right deal for me and my personality? I really like multifamilies as long as it's with the right operator and those metrics I mentioned. I really like mobile home parks. I don't like Class A multifamily. I like Class B and C multifamily because there's some downside risk protection. If rents drop, you're going to still see those still be very relatively stable comparative to A assets or something that may take a much bigger of a drop, right? You still have demand built in for those lower rent levels, right? So I really like those asset classes from that long-term play standpoint. And I'm looking at building extra equity to look at that downside protection. I like short-term promissory notes because I can get my money in and out quickly. I can recapitalize by selling a promissory note off very quickly and be able to have money to go pounce on a deal that I see out there as well in a relatively short period of time, because most of these promissory notes are 6 to 12 month construction loans, and I can go through and liquidate those things or sell it to another investor that wants to help me recapitalize some of my money in the deal. And in the meantime, I'm making a great return on my investment while I wait for that one to pounce on. So, or another one of your guys' deals to come up that I'm like, yes, let's go into that one. Let's move some capital over. And it's a lot easier to say, okay, in less than 30 days that I can get some capital out to go and invest in this deal here and there. And while I'm keeping it deployed consistently as possible over here to keep that cash flow in.
Absolutely. So basically, what you're saying is you're always keeping the money in the market and ad hoc, you'll pull it out and allocate it accordingly. And I love that. And that's such a good strategy. Matt, I know you have hot takes. I know you have sizzling takes. I know you have opinions. Okay. So, one question I like to ask is what is your hottest real estate take? Do you know what a hot take is? I would imagine
Uh,
you do.
you have to explain what you mean by it. So tell me what you want.
A hot take is something that's maybe contrarian or something that, a viewpoint that you feel is slightly different. So I actually thought, and for instance, I had a couple of them. Number one recent one I knew was going to come is that they were 100% going to bring back 100% bonus depreciation, no pun intended, because of the fact that if Democrats took this away, knowing there's a looming recession, knowing that, one of their presidents is at office, they would want to pull the economic levers. So I was very confident once they were even whispering about that. They put that out there just to kind of get a feeler for it. And they know that, hey, listen, Democrats own real estate too. And we all like to take advantage of the loopholes associated with our business. So when I heard that, boom, it was an easy take. It's like they're 1,000,000,000% going to bring that back. And of course, they got to push it through the final segment of the House of Representatives, maybe the House or Congress, one of them. But it's going to probably go through and restate 100% bonus depreciation. So that was my hot take from a bit ago when they even started talking about it. So it's kind of a contrarian take or something that maybe is slightly against the grain. I know you've got some slightly against the grain thought process. That's probably why you're so successful, because you see the world through a different lens. So I'd love to know what your hottest real estate take is.
Yeah, so I think, thinking about it, I think one of the best the things that I'm concerned about most, or I think is gonna, change is I don't know that necessarily mortgage rates are going to change and bump down. Like a lot of people are very thinking that they're going to jump down, right? I don't know that that's necessarily going to happen. I hope that happens just for my own sake and some of my investors' sake, of course, just because things pencil a lot better when that occurs. But I'm not banking on that strategy to occur because right now they're still going to be fighting inflation, right? inflation is a bigger killer of an economy than a rate change. And what we're seeing right now is over this next year is it's an election year. They don't want things crashing. They don't want things, to occur negatively. It may go down a little bit for that, but then that may increase inflation and ruin their chances over here because of the inflation aspect. So I think they're afraid to actually lower rates because of that inflation bug that's in everybody's ears, because the politicians know that if inflation occurs, they're not going to get reelected. They're not going to win the election process if whether it's Biden or someone else, in place. There's all this hoopla or who the heck it's going to be, whatever. It doesn't really matter. It's all controlled in the
Yeah,
first
we
place. I
would
don't.
love to have
So
we can have a spirited conversation about that
yes,
for a couple of
yes,
cocktails and you know what, and
right, right.
really chop it up. Yeah,
So
awesome.
I
So
think I
that's your
think
take.
the interest rate piece is the biggest thing that I really don't think that necessarily it's going to go down like a lot of people are believing because of this inflation bug over here that they're concerned about, along with, they want to, if they weren't worried about inflation, they're dropping rates because they're going to make everything look better right now. That's the game plan.
Yeah.
So but then on the other side of things, maybe they're trying to crash everything on purpose so the rich people can grab it all up and, take it all from the little guy and control all the assets even further. It's a matter of how much can they swallow when they create these economic catastrophes to occur in the first place. They're never holding the bag themselves for any of this stuff. And in 2008,
Nancy
when they went,
Pelosi.
yeah, shocker. Go follow her stock tips or what she invests in.
Yeah.
You'll
My
make a
guess is
killing.
probably
So
Nvidia. Yeah.
yeah, yeah.
Yeah.
And so, during 2008, I don't know if a lot of people know this, but they made it so with Dodd-Frank that you can't go have a bank bail out anymore. You have to have a bank bail in. That means that the people that are holding the deposits in the accounts are on the hook, and they are unsecured creditors. So these banks that go make all these risky positions with fractional reserve banking are coming in, and if they take a major hit, they're going to pay all their creditors off first. They're going to pay all those. Then whatever's left over is stock ownership of that bank that's a worthless bank now of the depositors. But they might take a haircut of 10% on their money. Now, FDIC is available, except if all of the banks fail or a big chunk of them fail, they only have money for like less than 1% of all the deposits in the accounts in the first place. And so that piece concerns me because I'm looking at, what are they going to do? They're going to throw it on taxpayers in this side. And, are they trying to protect the economy or are they trying to crash it to take advantage of chaos, which based on their history, I'm a little skeptical that it's option one. So,
Yeah. Well,
but
and also I'll just say this, unfortunately we live in a society where the government can print, money whenever they like, however they please to serve their narrative. It just goes to show the importance of the conversation we're having today, which is to hold and to invest in assets to make sure your money is working for you. Because if your money is just sitting in the bank, it's getting
right.
devalued and it's getting devalued every day. Inflation is going to run its course, and those who are holding cash before, we're not in
Yeah.
as good of a position. But with that said, Matt, we really appreciate you coming on the show. Where can people find you, reach out to you, find your incredible due diligence checklist and all those good things? I know you're a content creator and such, so please, please, please plug yourself away right here.
No problem. Well, I have a YouTube channel, OCG Masters of Real Estate. I also have a podcast as well. And then you can find all this information at MathewOwens.com, MathewOwens.com. And you'll see all of our different investments, the strategies we implement, as well as, our due diligence checklist. We have some master's courses on there that teach people how to find deals, how to analyze them, and how to raise all the capital they need for their deals. So lots of cool stuff and freebies that I give away just to try to teach people and help people, because you got to give it back. You got to help people as much as possible. And the people that want to work with you, they come to you. So you don't have to worry about
Listen,
it.
Matt is such an action taker. He's such a great guy. He truly has such a great understanding of the world of real estate, not just in a one-dimensional way, but from a 3D perspective, with his insights from flipping, from doing debt side of things, from raising capital to being on the principal side. You really do cover every angle. And guys, don't think you're diversified if you're just getting market beta from appreciation. Diversity is when you're taking a piece of the coupon, when you're doing promissory notes, and then you're investing in a long-term play. That is true hedging. That is true
Right.
diversification, not just investing in a bunch of deals in different marketplaces. You're just ultimately receiving some market beta. Plus, obviously, if you get migration trends, you're going to get a bump there. So consider
Right.
that perspective as well when you make your investment choices. With that said, thank you so much for listening. Everyone go shout out to Matt. Give him some love, call him, hit him up, and we'll all be providing value to each other. Thank you so much for listening to this show, A Fun Friday, and we'll catch you next week.